Hey everyone, Brian Bogner here along with Greg Towner, and it is time for our 5 charts in 5 minutes. Now, our recent episode we did was the 20-minute market breakdown. Of course, we was only a 10-minute episode, but we were focused on the banking crisis. Today, in 5 charts in 5 minutes, we are going to be focused primarily on the debt ceiling issues that is being talked about right now and how it affects the market. And our goal today is to bring you some information that is not being discussed in the headlines in the media, right? So let's go ahead and get started. Greg, take it away.
All right, thanks, Brian. Well, while we're going to talk a lot about the debt ceiling, let's just kind of give a brief overview of what the market's been doing lately. And believe it or not, not too much. We've been talking for a while that we think it's going to trade in this range, and it's not only traded in a range, but it's traded in a very narrow range here in the last few months or so. So it's basically waiting for some sort of initiative to break it out to the upside or potentially downside. That could happen. But for the time being, it's trading pretty narrow. And of course, one of the things that it's the market and investors are keeping their close eye on is the debt ceiling, right? So I know in this chart here, we look at the kind of reddish columns are the total debt outstanding going all the way back to 1970. The blue line is the debt ceiling itself. So what is the debt ceiling? Let's take a step back a little bit. It's basically just a level where legislature has to approve the ability for the government to keep spending and basically raising the debt level. And it hopes to kind of control the spending. Well, I mean, we can see from this chart that really probably hasn't worked too well, right? I mean, the debt keeps going up higher and higher, just allows politicians to kind of do their thing to make it look like they're, trying to, find some sort of agreement to hold back the debt and all that. The latest on the negotiations right now, yesterday, we're recording this on Wednesday, May 17th. Yesterday there was seemingly some positives coming out of negotiations. They are actually negotiating, it sounds like, as opposed to just stating demands from each side. So, who knows how this can go? But for the time being, it looks like there's some positive action being taken. We want to see it signed and delivered, of course, right. But for the time being, some positives are occurring. We'll see what happens. And we thought this was really interesting, Brian. So the top chart is the S&P 500 going back to the 1980s. But the bottom is this index that evaluates policy uncertainty. And when you look at the statistics of this, the higher level of uncertainty in policy, the better it is looking out over the next few months for stocks.
Right.
Kind of looking at the sentiment. Now, right now, we're kind of in this, middle ground, a little bit high, so maybe it doesn't have a big signal. But if things went negative with the debt ceiling, you'd probably see this uncertainty level go higher. And instead of panicking about the market, we'd actually look at that, all else equal, as an opportunity for stocks to maybe do better from that point forward.
And why this is the case, Greg, right, is because when there's policy uncertainty, the media jumps on it, the headlines, it creates emotions, it creates fear. People make bad choices typically in their investments. And what does it do? It creates a longer term opportunity.
Yeah, exactly. It's just another way for us to always talk about sentiment. And speaking of sentiment, at the top here, back to the 1980s, U.S. Consumer Sentiment Index. And we can see back like at the low points, like back in 1980, really negative consumer sentiment was actually, kind of a low point for stocks then. Stocks did better at that point. Early 90s, another low point for sentiment, did well for stocks from there. If you go to the financial crisis, we had a couple of low points around that period where sentiment was low. Stocks ultimately did well. Just here this past October, we had a really low point in consumer sentiment, but it also was a low for stocks. So sentiment's dipping again now, perhaps partly due to the debt ceiling. We'll see how this plays out, talking about timeframes a little bit. And we've heard the Treasury Secretary talk about June 1st could be, when the debt ceiling hits. I've seen some other people do some really micro data crunching on it. It looks like we have a chance maybe to get to June 15th when some quarterly tax revenue comes in, and then that would get the government well into August potentially, or well into July, perhaps August. So it's hard to say right now. Sentiment can get a little bit more negative, but again, we would view that as a contrarian positive for equities if it hits them. This helps us kind of sum up the big picture of what we're talking about. This is a long-term chart, and you don't even need to necessarily read all the little fine print on here, but we can just tell you it's mostly a lot of negative headlines or things that were perceived negative at the time, and some real negatives. I mean, there's wars in here, financial crises. 2011 had the U.S. debt downgrade, so similar to people are talking about now. Some of these were at high points for the markets, some were at low points. But the point being, in hindsight, a lot of people have forgotten about some of these things, or you wouldn't know when they were, when they occurred. And ultimately, the market just kept chugging higher. It doesn't mean there wasn't problems in the meantime, but in hindsight, the market can kind of ignore a lot of this and move forward. And we think with the debt ceiling, it can make things get worse in the short term, no question. But we also could see it as an opportunity if it does that.
So in closing, we are seeing some progress on the debt ceiling. There is some movement. Oh, sorry about that. Let's try that again. There we go. Volatility is still possible. There's, headlines are still going to be published. Things are going to react to it. Again, we're not going to let these headlines move us around. Right. It's going to create uncertainty. Historically, that has been a positive for stocks. It's also going to create some weak consumer sentiment, right? Because there's uncertainty out there. Should I be spending? What should I be doing? This and that. Again, that can be a positive signal, as we've shown, for stocks as well. But again, the big picture, and we just want to drive this home with you, is that always events sound like reasons to sell, right? They always sound horrible. And why would I own stocks here? And why would I have any risk here? And oh my goodness, the world is ending. You must avoid that noise, because usually those are the times that there is great opportunity in the markets. So as always, please reach out to us if you'd like us to discuss how this affects your portfolio personally. Give us a call, shoot us an email, and we'd be happy to talk to you. Thanks so much for being with us, and you have a great day.